Welcome, Financial Planning World Community. Dan Davis, Bret, Sinak. Today we're here on a topic that I think is really cool. Everyone in this industry focuses on risk management at some level. And as you know, Financial Planning World, we're dedicated to bringing best practices to you. Our primary motivator is we believe right now in this industry, the tax advisor is the most trusted and respected advisor that clients have. I think that that's sad, and it should actually be the financial advisor. The reason it's not is our industry for the longest time has been driven by a sales process over an advice process. And I think that it typically takes 10 to 15 years of a practitioner before they're really producing an A-game advice. What we're hoping to do is be able to take that 10 to 15 years, stuff it down to 5. So from a best practice standpoint today, I'm joined by Bret Sinak, founder of Endeavor Wealth Management, and he's going to share with you something that I found really unique, and that's the way that he manages risk with his clients. So Bret, tell us a little bit about how you manage risk for clients.
So the primary way is we use a bucket approach where we have different assets that are assigned to different, earmarked for different purposes in the portfolio. Some are designated for preservation, some are for income, some are for growth, etc. But today I think what we're going to spend most of the time on is a particular topic, a tool that we use, structured notes. They are flexible. They offer a lot of the ability to protect on the downside, express views, and deliver different things. But so I think we're going to spend most of our time today talking about structured notes and how we use those in the practice.
If I could just interject with a little bit of a disclaimer. So if you, as a chief compliance officer for 80K Wealth Advisory Group, when you take a look at compliance for structured notes, the SEC is very protective of consumers, and they want to make sure that in complex products, that consumers aren't either misled or get misinformation because they don't understand it. So if you're not an advisor, we ask you right now to turn this off. If you are an advisor, we ask that you would only share it with other financial advisors, because that we want to honor the regulatory body and making sure that we're not crossing boundaries. And so some of the things we're talking about, the only way to truly understand them is to go more in depth with the whole product. And we're going to be touching on pieces of the features and benefits. But in order to really understand, is this right for your clients, you really need to dig deep into them. And Bret's going to provide you some resources for that. Tell us more.
So we use them in a variety of ways, essentially 3 primary ways in which we use notes. The first can be hedging, where it's essentially taking the equity portion of a portfolio, and simply by using a pretty simple, straightforward structured note that gives us some leveraged participation in the upside, but provides a barrier or buffer on the downside. So just by adding that piece to the equity sleeve can reduce the risk in the portfolio quite a bit. So that's one way in which we use them. There's essentially 2 other ways where we are actually constructing portfolios, an entire portfolio of structured notes. The first is income. You can have notes that, especially in the bond market that we're in right now, where rates are going higher, there's risk in bonds. For those of us 55 and under, we've never seen inflation, and we haven't seen interest rates.
55
That's right.
And older.
So we haven't seen interest rates go up essentially in a meaningful way, and we really haven't seen inflation. So this is a way to deliver income to a client that's not sensitive to interest rates and things like that. So essentially those assets are tied to equity indices, and they deliver a coupon payment as long as an index doesn't fall below a specified barrier, typically 30%. So if the index is down anywhere from down 30 positive, you will clip a coupon. So it's a nice way to deliver a coupon payment or an income stream to clients. And typically right now, if you can get a bond fund that's delivering in the 3 to 5% range, most of the notes, pretty straightforward with safe, stable indices, you're in the 5 to 8 range, so you can potentially deliver a higher coupon as well.
Excellent.
So that's one way is in an income format, if you will, or an income replacement. The other way is for growth. And typically we're using this for clients. If I go back to the buckets, we have bucket 1 is more the preservation and income. Bucket 2 is liquidity and bucket 3 is long-term legacy, maybe charitable intentions. This strategy, I think, is a really good fit in bucket 3. Quite frankly, it's money that clients may not ever touch. So, but in light of that, I still am a big believer in managing risk, even if it's money that is over a very long time horizon. So you can buy notes. There's a whole host of types of notes, whether it's a growth note that has a barrier, has a buffer, has leverage, has absolute return on the downside, digital returns. There's a whole host of different types of products that allow an advisor and or a client to express whether they think the market's going up, whether they think the market's going down, whether they think the market's going to be sideways. And what it really allows me to do as an advisor is not necessarily have to express a view, but construct a portfolio that's diversified over the indices that we use, the timing of when they mature, the type of product that we deliver, whether it's barriers, buffers, etc. So it really allows us to put together a portfolio with a lot of downside protection that allows the client to sleep at night, and with the potential to deliver returns that are in excess of the market because of the leverage feature in notes.
So you talked about the hedging, the income, and the growth. Go back to the hedging. So if you're doing it as part of a sleeve that then has other equities, is there some kind of kaleidoscope rule of thumb that you use for what percentage you would do of the equities?
So that's really up to the advisor and the client. But if you were to just take an equity sleeve, let's say you had a sleeve that was S&P 500, correlated, and if you just took a 10 or 20% sleeve and carved out a structured note that's tied to the S&P 500, you're going to get leverage on the upside. So in a rising market, you should do better than the market, but provide a lot of leverage. So it's anywhere from a 20, 30, 40% downside protection. So that protection is what really provides that risk management tool to give you a better outcome in a down market than just being long only equities.
And I know we'll get to challenges and pitfalls later, so let's defer on that. On the income piece, so as I was listening, I was envisioning that you've got, whether it's a growth with income strategy or whatever, that what you were talking about is the income piece of it,
right.
that would be completely in that, or were you thinking of something else?
No, so what we're doing with the portfolios is, instead of just constructing a 60-40 portfolio, for example, if it's really long-term money that we're talking about, we're going to carve out an equity piece and use growth-oriented structured notes. We're going to carve out an income piece. And if the client's large enough, the account's large enough, I actually like to do that in 2 accounts.
Okay.
Because you mentioned pitfalls. So one of the pitfalls is that the structured note, while it delivers this level of protection, it can be volatile on your statement. So the underlying investment, a zero coupon bond, and options. And the options piece will fluctuate based on the performance of the underlier, volatility in the market, and the time value. So what we're trying to do there is, typically those will kind of track with the market, so it's a little easier for the client to understand the experience. On the income side is typically a little different. The statement value can be a little frustrating for a client. So if I put $10,000 into an income note, it's not uncommon that the early on experience is going to be to see that note worth $9,500, $9,000, $8,500, and the client saying, wait a minute, you told me I had downside protection, it's delivering income, and I see a 10 or 15% loss on my statement. So that's a little frustrating. So the income piece, but it's going to deliver the income as long as we don't have equity returns that breach that barrier. And so we try to segregate it into 2 strategies. The client can understand that a little bit better, but they can be a little frustrating for a client to see on a statement because they will fluctuate in value based on volatility in the market.
Yeah, I know what you mean. The first time that I had done any structured notes for clients and talked to them about that, I didn't realize that they priced them mark to market on the statement. So then I had to circle back and do a little bit of damage control because I didn't handle that properly up front, setting expectations. So I see what you're talking about. So great.
Yeah.
So continue on with some of the risks that you were just talking about, pitfalls, et cetera.
So the client needs to understand that this is like buying a bond. So you are taking on the risk of the issuer. So if it's a Goldman Sachs, JP Morgan, Citibank, you are taking on the risk of them as an issuer. So I make sure the client understands that. And then the
So if the
statement,
issuer were to go bankrupt, for example, then they're a creditor
you're an
to that.
unsecured creditor of that
Okay.
Goldman Sachs or Citi or
Right on.
whatever. Yeah. So there is that risk. It might be low, but it is a risk. And
Right.
I make sure the client understands that they're taking on, as opposed to a government bond where it's the full faith and credit of the U.S. government. This is the creditworthiness of the issuer.
What are some of the other risks? I know there were 3, if I remember right, from reviewing your upfront material.
Yeah, so I think that's one. I think the other is that from an advisor standpoint is they're complex. They're manual. So I'm used to constructing a model for clients, and it has a certain weighting of stocks, bonds, mutual funds, etc. And that gets rebalanced, and when you do that, you can do that over 50, 80, 100 accounts, essentially the push of a button. The structured notes, because they are on a calendar and they come out each month, depending on when the money came in or when we've implemented the strategy for the client, every client truly is unique. So it can be a little bit of a challenge for the advisor to manage, because you're always having notes that are maturing or getting called, and 4 clients have this one and 11 clients have that one, and it can be manual. So from a time standpoint, there's some risk to the advisor of making sure that you have the bandwidth to be able to manage this for a client.
Any other risks that you think of before we sort of wrap some things up with this?
The other is that, so if you're owning an S&P 500 note, for example, you're foregoing the dividend, so you don't actually own the ETF, you own options on the ETF. So if it's a 5-year period, you're foregoing dividends,
Right
and
on.
if you owned it in an ETF or mutual fund that you'd be getting. So
Okay.
that's one thing a client needs to understand. And I think the other is just their clients haven't seen them, so it takes time. Every review meeting I do, we reiterate the structured note strategy, what it is, what it's doing for you, and trying to get the client more comfortable. But there is a learning curve for the client, and it can be time consuming.
I know in our conversations you were really adamant about how in your journey as a risk manager that you've seen a variety of different strategies and you've used different ones, and this is one that you've metamorphosized into and that you feel very passionate about. What if you were going to tell the financial planning world what the main part of it is to why that is, what would you say to them?
So I think it's we started managing risk using options, right, 15, 20 years ago. That's really a difficult and hands-on process. Then we were more tactical in how we managed money, using momentum-based strategies, and there were times when you would raise cash or be in or be overweight. That's a tough game to play too. Anytime there's a reason why nobody does everything the same is because nobody's found the thing that works all the time.
The secret sauce.
Right. So that can be challenging as well. So really the practice has evolved from more of that, what I would call money management, into wealth management. So it's that planning aspect, and I think that structured notes fits into that. Is we're not trying to time the market, we're not trying to play offense or defense at different times. This allows a client to stay invested and know they have downside protection. There's a lot of data behind them which is part of when we put together a portfolio, is we're using different timings. So for example, I tell a client that if you own the S&P 500 and you have a down year of 30%, your portfolio is down 30%. If I own structured notes that provide that same exposure, but I own a 2-year, 3-year, 4-year, 5-year note, at least statistically in the past, if we've ever had a down 30% year, 12 months later, in the history of our market, we've never still been below that barrier. 2 years, 3 years, 4 years out. So I tell the client I'm comfortable with, I don't like it, but I'm okay accepting the risk that we may have a position that's down more than the barrier, but my whole portfolio is not down more than the barrier.
Understood.
Now, who knows if that trend or that performance in the market will continue in the future, but there's some pretty good data behind the last 80 or 90 years how that market has performed.
Yeah, that's that old compliance statement of past
Future
performance.
results, right.
Right, past performance doesn't guarantee future results. What are some of the different resources that if someone's sitting out there absorbs this and wants to really grind into it and learn more about it, what are some of the sources that you use that they should consider looking into?
So within LPL, the best resource is Simon. It's also why I'll come back to that as a resource.
Great.
But it goes back to the kind of how the industry's evolved. Is I think this strategy or this tool is here to stay, and I think it's going to be more and more widely adopted. It's still the only investment vehicle I know of where the U.S. is not the biggest player. So the rest of the world has adopted this at the retail level a little bit quicker than we have. So Simon, that I would start there as a resource. I've never seen the industry cooperate with each other, whether it's portfolio construction or no construction, or their information or collaboration like I have with this. So Simon is an industry resource, and all the issuers subscribe to it. All their notes are out there. You can do custom pricing. It's out. I've never seen that kind of transparency among the competitors in our market. So I think that is a leading indicator to me on this is here to stay. And I think it's going to become more and more widely used. So I would start with Simon. Simon has some great videos. They have some tutorials. There's some training out there. There's just tons of information. Some of it's a little overwhelming, but I would start there. And I would contact the outside folks. LPL has relationships with 2 or 3 companies that are the distributor of those products, and they're more than eager to introduce the concept. So I'd pick their brain as well.
Great.
They have resources, brochures, things that are client approved that you can look at. And that's the other thing on Simon is there are client approved videos. They're very simple. They're animated. They're a little silly at times, but I think they tell a pretty good story. So using those videos with a client, there's a client approved section there as well.
Excellent.
I think some of the clients they're a little silly, but you get the point.
Anything else on this topic that you think is germane before we wrap things up?
No, I mean we might want to cover like who do we think this is for, and who do we do we not? And I'm actually just going to read that because I took that kind of out of various pieces of information and put that together. So I think the first, let's say, who should invest. So investors looking to reduce risk, looking for some partial downside protection, mitigate market fluctuations, and they're willing to hold to maturity. I think that's a real important point I probably should have made earlier, is that some of these are long term. I mean, 3, 4, 5-year notes, and I make sure the client understands that our intent when we purchase these notes is to stay in this until maturity. These are not to be traded. We don't want to treat them as liquid securities that we want to buy and sell. There is a secondary market. I've never had an issue where we did need to sell one where we couldn't, but I'd hate to see a client have a 15 or 20% statement loss, be 100% on the intrinsic value, and then sell it early when we know if we just hold it to maturity, we're going to get our principal back. So I think making sure that they understand that there's a commitment, our expectation is not to sell these early. So who shouldn't invest? If you're not comfortable with assuming losses that exceed a buffer or barrier, you probably shouldn't be investing in these. If you are not willing to forgo the dividends that the underlier pays, you probably shouldn't be investing in these. And if you're not comfortable with the credit risk of the issuer, so for whatever reason, if you're not comfortable assuming the credit risk of Goldman Sachs, Citi, JP Morgan, et cetera, then this is probably not the right product. The other thing is I would encourage you to kind of stay in the mainstream when you're using these initially. And what I mean by that is the indices that we're all familiar with, the S&P 500, Russell, Dow. There's some international indices I think are good as well if you want that exposure. But I would stay a little bit away from some of the more exotic ETFs and underliers. We've had a little bit of experience with those, and I would just, until you get your feet wet, I would stay with the broader indices that clients are familiar with, we're more familiar with.
Excellent. Yeah. So in wrapping up, I want to thank you as a financial advisor who's investing their time to really advance your knowledge so that you can help clients. Because Bret and I went to high school together at a Jesuit all-boys school, and one of the things that they preached to us at that time was this pursuing a standard of excellence. And I have to tell you, it was sort of like that Charlie Brown wah 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 when I was listening to it, but it sowed a seed that many years later was a profound epiphany that said that pursuit of excellence in helping other people is really a way that you enjoy life. Because if you know that you're pursuing excellence and helping people, whether you're making a lot of money, a little money, medium money, you're receiving gratification from that. And then the other thing is you're truly helping people. And as I alluded to at the beginning of this, our industry needs to take a step up in the quality, moving away from sales-driven processes to advice-driven and to best practices, learning from that, sharing it with others. We're committed to that. Thank you for taking the time to do that. Check out financialplanningworld.com. There's a host of different venues of best practices there. Share it with other financial advisor professionals, and then go to LinkedIn and follow us on LinkedIn. That way when we do this material and push it out, you're getting it firsthand. So again, thank you for your pursuit of excellence. We're here to lock arms and join you in pursuing that to help your clients. Thanks, Financial Planning World, Endeavor Wealth. Have a great rest of the day.